and welcome to this installment of Frank and Mary here in Southborough. If you have not seen the show before, my name is Arthur Bergeron. My day job is as an elder law attorney at Myrick O'Connell. I'm right down the street in Westborough.
That's not very.
But of course, this is not my my day job. This show is about my friends Frank and Mary. If you've been to the Senior Center before, you've seen me do presentations where I refer to Frank and Mary and their goal in life, which is to live in their house until they die and be buried in the backyard. And if that's Southborough, that means they don't want to move. They want to be right here. And so the goal of the show is to present you with information that might be helpful for you, people you might want to know, programs you might want to know about, just so that you can stay right here in Southborough. So I found this great co-host, Doug Peck, who is from Southborough and we've been doing these shows now for like a while, Doug, like a couple of years, I think.
Couple of years, yeah.
Because he keeps finding these great people to interview in order to provide you with information. And I've heard he's got a terrific guest this week. Doug?
I do. Arthur? It is our own Arthur Bergeron today.
No, me.
We are going to talk a little bit about what we consider to be an important legal issue, particularly this time of year. As we wrap up the year, we want to make sure we get people to understand what they can and can't do. And so we have a thing on gifting today, and Arthur's going to talk about that. So Arthur, let me start with you. What do you want us to talk about first?
And I was going to say, thanks for inviting me. And I know when we talked about this show, it was really because I mentioned to you, you said we had talked about, so what are the issues that people bring up, like at the end of the year, where there's some things that people need to think about. And this is always one. This is the most common one, because people think about, that there are big concerns with, they get making gifts to their kids or to the other loved ones, and how does all that work? And aren't there limits on how much they can give and all that jazz? And so I figured this would be a good time to talk about this, to dispel some of the myths around this.
Yeah. I mean, I even thought of it about myself, where instead of giving Christmas presents, maybe I give them, I have 3 kids, maybe they get a gift from me, and we do that every year. So I'm very interested in this.
So let me just kind of talk about this, because I guess I'll talk about it in relation to Frank and Mary. Although let's pretend, we'll pretend for our purposes that Frank has died and we're just talking about Mary right now. Although all the same rules would apply, right? If it were Frank and Mary. So commonly I'll get a call from Mary, right? Oh, your cat's even on the show. That's terrific. This is like the PBS NewsHour, where actually all of the people who are the guest commentators, inevitably, the big reviews are on their cats, right? So say it's Mary, and Mary is saying, oh, I'm really thinking about making a gift to my kids this year, but it's my understanding I can't, there's a limit to how much I can give. There's a limit to how much I can give. So let me talk about that for a little bit, because there really isn't a limit, but you really want to kind of understand what the reason is for that. So first of all, and this other question often comes up. Mary will call me and say, I'm making gifts to my kids, but aren't they going to have to declare that? Isn't that going to be income on their income tax? And the answer to that is no. No matter how much you receive as a gift, it's the same thing as if you receive a bequest because somebody has died. What you're getting is not taxable income. It's a gift. Therefore, you don't have to report it any place. You're not paying income tax on it. The only time the income tax issue would come up would be if Mary it has decided to make you a gift from some of her money that's like in her IRA. Because in that case, she's going to have to take the money out of the IRA first, before she can make the gift, and she's going to have to pay the tax on that money, before she makes the gift to her kids, okay? So there isn't any income tax, but then there is this common, this notion that, and even if I said to you, isn't there some limit to the amount that you can give to somebody? I guarantee you there's a number that you're going to tell me, and it's going to be somewhere, what would that number be?
I thought it was $1 million, to tell you the truth. Not that I can gift $1 million, but no.
I get that. Yeah, that's an estate planning question. But by the way, we're going to talk about that a little bit. So the number that you commonly hear is $15,000, although I hear numbers ranging from 10 to 15. So let me explain why people think this, okay? First of all, there is no Massachusetts gift tax, okay? And as a result of that, and this goes to what you just said, as a result of that, for people who may have more than $1 million and who are concerned that if they leave their kids that money, there's going to be a Massachusetts estate tax because Massachusetts taxes estates of more than $1 million. One of the things that I'll tell my clients is, you know, you can just give them all that money before you die. Well, of course, now Mary doesn't want to give all of her money away right now because she's concerned she might need it, you know. But one of the things I'll recommend to people is I'll say, you know, if you've given, and you know, if Mary has given one of her kids, remember her kids are Peter, Paul, and Mary Jr. So say Mary has given her son, Peter, the oldest one, a power of attorney. What you may want to do is tell Peter, look, I don't want to give my money away right now because I might need it. But if I get really sick, right, and it looks like I'm going to die, before I die, use my power of attorney, go to the bank and give away all my money to the 3 kids, because that's what I was supposed to do. And if he does that, if he manages to get those gifts made the day before she dies, all the money that was given away gets subtracted from the taxable estate. If he gives away all the money and the day she dies, she has nothing, she pays no estate tax, right? So for Massachusetts purposes, you can do that as an estate planning matter. So at the federal level, though, there was a federal estate tax also. But quickly after the federal estate tax was created in the 1920s, they caught on to the fact that you could do this, you know, that you could just give away everything the day before you die and avoid the tax. And they said, well, we want that to happen. And so what they did at the federal level is they adopted a gift tax, right? And they said, if you give away a lot, right, there's a gift tax. And so, except that, when the federal system has 2 big exclusions to the gift tax, right? So you don't pay a tax if the gift comes under one of these exclusions. So the first one everybody knows about. The second one nobody knows about. The one everybody knows about is that in any year, if you give a person below a particular amount per person per year, then there is no gift tax. And not only that, there's no gift tax return that has to be filed. There's nothing, okay? And that amount was originally $10,000. But over time, because of inflation, this is built into the statute, that number has increased. And at this point, it's $15,000, right? And everybody knows that rule, that they know there's some number, right? That above that number, they can't give it away. But no one knows the second exclusion. And the second exclusion is for any gift above that amount, above the, you know, 15,000 to one person. So if Mary is giving away, says today, I want to give Peter $115,000 right now, okay? So the first 15,000 of that would be covered by that exclusion. But but in addition to that, there is a lifetime exclusion for gifts over those magic numbers equal to the estate tax exclusion. The estate tax exclusion right now for federal purposes is over $11 million. Oh. So you don't pay any gift tax, no matter how much you give, until the amount of your gift combined with your other gifts, not the gifts that were below 15,000, but all of your other gifts, your non-excludable gifts. You don't pay a gift tax until the combination of all of those exceeds $11 million, right? Which means as a practical matter, right? For most people, even most people in Southborough, right? And I deal with a lot of folks, you know, at various asset and income levels. But $11 million is a lot of money. Right? Yeah. And so unless you have already given so much that Mary making this gift to Peter or Paul or Mary Jr. is going to put her over that $11 million, there's no federal estate tax, right? Because you're just still below that exclusion. So as a practical matter, there really is no estate tax. Now, this leads to one issue that I mentioned when I started. And I'm sorry this is a little complicated, but I think this is a big, myth that we need. I really try to dispel for people. And that is that there is a requirement in the federal statute that if you're giving away more than those annual exclusions, what is now $15,000 a year, you have to file a gift tax return. And accountants will all tell you this. Oh, well, if you make these gifts, you got to file a return. Well, sometime if your accountant tells you that, ask them, what happens if I don't? Because of course, that's the kind of lawyer type question. Lawyers are always interested in the real question is not what happens if I do obey the law, but what happens if I don't obey the law, right? Because that's going to determine whether I'm going to obey the law in many cases. Right. So the answer to that is nothing happens if you don't file the return, and unless you owed a gift tax, because the penalty for not filing the return isn't like a fixed amount. It's a percentage of the amount of the gift tax that you owed. So if you don't owe a gift tax, there's no penalty, and therefore you don't have to file the returns. So not only is there no gift tax, but there's nothing that you even have to pay for, because typically gift tax returns, people are going to charge for that $500 to $700 has been my experience to prepare the gift tax return, right? But you don't have to pay it. You don't have to pay it. You don't have to file the gift tax return. And there's no limit to the amount that you can give. Okay, so first of all, that means right now, if it's December and you're thinking about making some gifts to your kids, but you thought that you were faced with this cap, you're not, okay? Second, if you are interested in avoiding the estate tax, the Massachusetts estate tax, right? Then you may want to think about making those larger gifts, right? Or at least, now, or, making a large gift, keeping some, whatever you think you need, especially if you're older, whatever you think you need. You don't stress yourself out over this. You don't want to lose sleep because now there's no money in your account, right? But you can always give it away and then tell the person who has your power of attorney, right? Look, if I get sick, give the rest of it away, right? So it's just good planning.
So does this, do you have to give it away before the end of December for be in effect this year, or do you have?
See, this is the point.
It doesn't matter.
It's all irrelevant.
It doesn't matter.
It's all irrelevant because people are often gifting. They're gifting at the end, by the end of December, because they think that there is this limit of this $15,000 on the amount they can give, and it's got to be out the door by December 31st. But it's all a joke. The whole thing's a joke. Okay. Now, I do want to, I want to put a couple of caveats into this, right? Because the first question that people will say is, well, first of all, you don't want, if you try to give away your IRA money, before you do that, you're going to have to pay the income tax on it, right? And so you want to weigh out whether it's more beneficial for your kids, right? If you hold all of those assets until you die and they're part of your estate for estate tax purposes, right? But at least then they don't have to take it out right away because it's IRA money, right? Versus pulling the money out now and pay, which means you have to pay the income tax now, but you've avoided the gift tax then or the estate tax because you gave it away early. So there's that issue. The second issue is if I make you a gift of an appreciated asset like a stock. If I give you, say I have $100,000 in stock and I bought that stock for $20,000, right? A long time ago. Now, if I were to sell that stock today, I would pay a capital gains tax on that stock, on the difference between what I sold it for and what I bought it for. What I bought it for is called the tax basis. What I sell it for is what I sell it for, right? And the capital gain would be on the difference between what I sold it for, which would be $100,000, and what I bought it for, which would be about $20,000, right? And the capital gains tax, there's a federal one and there's a state one, and the two put together equal about 20%. So if I were to sell that stock today for $100,000 that I had bought for 20, the capital gain would be $80,000, And the tax would be 20% of that, or $16,000, right? Now, and I know this is a little complicated, but if I give my stock to my kids, if I gave all my stock to Peter, the giving of the stock will not cause a gift tax, and receiving those stock will not be income to Peter. So, right, just as we discussed. However, when I give him my stock, I give him my basis also, my tax basis, that $20,000 basis. So if he turns around to sell the stock later, he's going to pay a tax on the difference between what I bought it for, $20,000, and what he sells it for. So if he sells it for $100,000, he's going to pay a capital gains tax on that difference, the $80,000, right? If, on the other hand, I hold that stock until I die, on the day of my death, that basis jumps. It's called a step up in basis. It jumps to the date of death value. So if I died today with $100,000 in stock, even if I bought it for 20, my basis would jump to 100. And if Peter inherited it and sold it the next day, he'd pay no capital gains tax, right? So from Mary's perspective, she's going to want to compare, right? And this is a math question, and it's a question that she'd probably want to raise with her accountant or with her tax lawyer. She's going to want to compare. What's the better thing to do, right? To hold it until I die so that the basis jumps up, so that when my child gets, sells it, they're going to pay less capital gains, or to give it away now, knowing that as a result, there'll be less estate tax, but on the long run, my son, somebody will have to pay a capital gains tax. Does that all make sense?
I have a question. It's really about the power of attorney, because I think that's important here.
Yeah.
So I have heard that when someone is still alive and they have the power of attorney, they don't necessarily have the right to go in and take money out of a person's account. Is that a special part of the power of attorney? Does that have to be inserted, that they can go in, sell stock and move things around? Or is that normal now that they can do that?
Like, that is a really excellent question. And for a couple of reasons. First, gifting in general needs to be in the power of attorney. It needs to be specified, because it's assumed otherwise that the person who is acting as your attorney, while they have the right to, pay your bills and stuff and act on your behalf, they don't have the right to give away all your stuff. So that has to be specifically in the power of attorney, right?
Oh, good.
And secondly, what you really want to look at your power of attorney, because many of the powers of attorney have this silly provision in it that says that the gifting power is limited to this federal gift exclusion amount, that smaller exclusion amount, right? Because for some reason people put that stuff in. It's astonishing to me, right? So to the extent that you want your attorney to have the kinds of powers we're talking about right now, you absolutely want to do that. You want to make sure that there is a power of attorney provision that allows that to happen. And by the way, just in general regarding powers of attorney, as I tell clients, when you were asking about, what kinds of things do you want to be concerned about at the end of the year? One is, if your power of attorney has not been updated within the last 5 years, you probably want to do that, just so that the people that your son or daughter or whoever have to deal with won't think that the power of attorney has gone stale. Technically, powers of attorney never expire, but a lot of people think they do. And the point is, the person deciding whether they have expired or not isn't going to be like a lawyer or a judge. It's going to be like the guy at the bank, when you go to try to use the power of attorney. So try to keep that power of attorney.
So when can they get sort of turned on? I mean, let's say again, Mary is in the hospital and very sick, and she says to, so-and-so, you've got my power of attorney, you can do this. Well, how does everybody know? I mean, if you have a death certificate, that's one thing, but.
So typically the powers of attorney the typical power of attorney just keeps on being valid. From the time that it's signed, the person that you've named as your attorney can act as your attorney. Some folks who are concerned about that being abused will put a provision into the power of attorney that says this power of attorney it's called a springing power of attorney. It will spring to life only if my doctor has certified that I can't make decisions or something like that. We never recommend that.
Okay.
Because then it adds this whole other level of complexity to dealing with the power of attorney. So in general, when you've signed the power of attorney, it's valid right away. Typically, you just tell whoever's got it, don't use it unless I need it, because by doing the power of attorney, you're not relinquishing any of your own rights. You're just saying that this other person has the ability to do it in addition to you, right?
Okay. Oh, that's good. Okay.
Does that all make sense? Okay.
It does. It makes sense, and that answers my question, because
so now
it gets a little confused.
It is a little, but now I just want to add one other issue, and that is regarding the house, because one of the most common gifting issues that comes up is, well, I'd like to give my kids my house because that's where I want to, you know, that I want to leave it to them anyway. So the question is, should I give them my house before I die? And the only problem with giving them the house before we die goes back to the stock issue, right? If you bought that house for $30,000 50 years ago and it's now worth $500,000, while you're living there, if you sell it, you get a special capital gains exclusion because you've been living there. But if you give it to your kids, they're going to get that, they're going to get that basis, but they're not going to get the exclusion, and they're going to pay a boatload of money, right? The way to avoid that is to instead of just giving them the house, to keep something called a life estate in the house. That is control of the house until you die, and give them the rest, the so-called remainder interest. It only kicks in after you die, but you've already transferred it. Now, for gifting purposes, right, that you haven't made the gift yet, and for estate purposes, you haven't made the gift yet because you kept the life estate, right? So that when you die, even though your life estate expires, the tax basis will jump up again. Even though you kept a life estate, the basis in the property will jump up to the date of death value. So when your kids go to sell it, they can sell it tax-free, right? Now, the disadvantage of doing that is that for estate tax purposes, the property is also still owned by you. So you haven't avoided the estate tax. But what you have done is you've kept that step up in basis, which is really, that's the big tax hit regarding a house.
Well, this has been very interesting, because I think what it says to people is that you really have to think about these things. If you have some money and you really want to, you know, show some appreciation to your kids, give them something. It's a complicated, but it's an easy. But with somebody who can help you through it, you can make some good decisions
and save your kids a lot of money. Because the goal when you're giving these things is you want to give it to, you don't want to give any money by mistake to the IRS. You know,
right?
You really want it to all go to the kids, and there are ways to do that, but you need to pay attention. But once again, the main lesson, and that's why I appreciate your being willing to do this show. The main lesson for people is there's no limit really to what you can give.
That's good information,
right?
Yep.
So Doug, thank you very much for inviting me onto the show.
Thank you, Arthur. It's been a pleasure interviewing you for a change. Yeah.
Yes. So folks, I hope that this was helpful to you. I know, once again, 'tis the season. It's the time to give things away. For all of you who thought that you always had to be rushing around before the end of the year to make these gifts in these more limited amounts, that's all a joke. You can just give them kids, you know, if you're feeling generous this year, just give them whatever you want, right? But talk to your tax accountant or talk to your lawyer about this first, just to make sure that you're not inadvertently having some other bad consequence because of these capital gains. So thank you very much, Doug. Great. We'll look forward to doing the next show. I keep wanting a show. Well, I've done one where I can interview you. We're going to do that first thing next year. We're going to have you interview you again, right?
Right.
Folks, thank you very much. We hope you enjoyed the show. We'll look forward to seeing you on the next installment of Frank and Mary here in Southborough. Thank you.
See you, everybody.